In this video, I'll be running through a 7-figure brand that was running acquisition unprofitably and how we turned it around within 30 days. I'll spend the first few minutes contextualizing the position of this business. This is a really interesting scenario, and so I think there'll be a lot of value in it. We'll then dive into exactly what we did and the next step that allowed us to turn acquisition profitable within the first 30 days of working with them, and then what we're doing moving forward. Whether you're an in-house brand or a performance marketer watching this video, I think it's going to be incredibly valuable. Some of the lessons that we had here, as well as just the identification process of ensuring that this brand actually was profitable on acquisition because they were confident that they actually were. And so let me first give you context about this. This is a cohort analysis over time of how many new customers they were acquiring, what their blended CAC was over time, and then what their 30-day LTCM to CAC ratio is. And so this is a division of profit on first purchase divided by the blended CAC number. If this number is below 1, it means you're losing money on acquisition because the amount of gross profit that you're making on first order is less than blended CAC. If it's between 1 to a 2, you're in a position where you can scale depending on your target profitability metrics and how lean you are on operating expenses. And greater than a 3, you shouldn't really be greater than a 3. You should be scaling up acquisition immediately. You're in a great position. You can see that historically back in 2022, they were doing incredibly well when it came to LTCM to CAC ratios. They were very profitable on acquiring customers, and they also have an omni-channel presence here as well in terms of in-person stores. Moving into mid-2023, this ended up significantly changing. Okay, blended CAC went up substantially, and they actually dropped into unprofitability on acquisition. There's a really important caveat here, which is that when you look at their overall P&L, how much profit were they actually making across this time period? They were profitable here, and then here, they're still actually profitable. And the reason they're profitable is because they sell consumables that have quite a high returning customer rate. And so they get decent repeat purchases. It's not incredible, it's not amazing, but it's decent enough, and they've been around for long enough that they have a really large customer database to where they have sustained repeat customer revenue coming in on a monthly basis that's helping with the profit of the company. The issue is they got external funding right in here. And this external funding, their approach was, well, you're great on acquisition, okay? You're spending almost nothing to get these new customers. So let's go and double budgets and just acquire double the amount of customers and we can double the business. And so they did that. And you can see that when budgets doubled, new customers didn't change. All of that budget that was laid in, which is tens of thousands of dollars, resulted in no incremental new customer acquisition. All it resulted in is the cost to acquire customers doubling. And that then drove LTCM to CAC negative, which now meant that they weren't even repaying the cost to acquire these customers on first purchase. Now, in the first month of this occurring, it wasn't too bad because they had a 4-month CAC payback period, meaning that they would acquire these customers, these 400 customers, and then these customers would pay their own cost off after 4 months, and then they would start generating profits. The next one was okay at 0. But then they went into 14 months, then went into a cohort that still to this day, after a year and a half, has not paid itself back. 10 months, 1 month, 1, 6, 4, 4, and then all of these recent cohorts haven't repaid themselves. And so they've put themselves in an incredibly dangerous position where, yes, about a year after trying this strategy, they are acquiring significantly more customers up in the 600 range, but they're doing so at such an extra cost that these cohorts will never repay themselves. And if you actually run the math here, they technically will repay themselves, but after 27 months. It takes 27 months for these people to be profitable. The return on invested capital here is just so bad. And after 27 months, they generate almost no profit anyway. You're going to get a few dollars out of these customers. The margins are terrible on that kind of time horizon. And then put value associated with these dollars over time, and these never repay. If you actually put a 4% return on invested capital on the cost of money by acquiring these customers and looking at a return, you would never get a return here. You would be better off taking all of this money that you're putting here and just putting it into an index fund. And so this is not a good system at all, and they're not operating on a acquisition model that makes sense whatsoever. But the reason that they're doing it is because they have a bunch of returning customer revenue that's propping up the business, and they're running at about break even, which was the objective here. The objective was just acquire a ton of customers, let's operate at break even, and then those customers will come back and buy down the line and we'll make money. But not if you're acquiring them at such a loss that you will physically never make money on them. And so that's why visibility over the acquisition strategy in these metrics is so unbelievably critical. If you're just looking at top line revenue and bottom line profit, new customer and returning customer revenue is going to be blended together, and you're not going to get an accurate read on what is contributing and how these two things pair together. And so the first-time customers are just getting acquired, all unprofitably, and this is going to hit the P&L eventually. And in fact, I would say that they were probably 3 months away from disaster here, because 3 more months of acquiring customers unprofitably and running at zero, they have to, and let me visualize this really quickly, they have returning customers over time. Let's say this is revenue. This is returning customer revenue. Let's call this RR. And then this is time. This is what their returning customer revenue looks like, but it is going to start to decline eventually. Why will it decline? Well, because they can't sustain this kind of acquisition forever. They're not making money here. And so they're going to have to pull spend down and start to acquire less customers. And the moment they do that, their returning customer revenue dips and the brand goes into unprofitability. And so this brand is just spending and never becoming profitable because the unit economics in acquiring a new customer currently isn't profitable. We can also visualize this based on a first-time customer P&L breakdown. And so this is net revenue, gross margin, direct advertising and marketing expenses. You get contribution margin here. And then EBITDA, same thing, because there's no OPEX inserted. And so you can see that if we're just looking at the P&L and just looking at first-time customers, we are taking losses of $2,000, $4,000, $4,000, $6,000, $20,000 in losses in May, 17, 9, 8, 4, and then this is when we started with them. And so we started in mid to early October to start turning this thing around and start transitioning the accounts over. So you can see that their acquisition MER, or their acquisition ROAS, and that's a terrible line I just drew, is not high enough to be able to drive profits on first purchase. And in fact, it's fine if they're not driving profit on first purchase, but they at least need to be in control of their blended CAC in a way that's going to make them profitable after 2 to 3 months. Any longer than that, and you're associating an incredibly high degree of risk to the business, and there's not enough growth after 3 months to sustain a target profit percentage. And so worst case scenario, they should be reorientating to a target blended CAC of about $28 to $29 or maybe even $30. And so that's exactly what we did. We had a meeting through this. We ran through all the numbers. We came to this assessment and we went, all right, is the target to be profitable on first purchase or is it to be profitable at the 3 to 4 month mark? We decided the 3 to 4 month mark due to the invested capital and the growth of the business. And so blended CAC was reorientated to $30. In addition, we did a few things to increase average order value as well. And so then in November, which is really our first true month of being able to work with this business, blended CAC came down to $30.71. New customers went up. This is conducive of November in itself. So we're not going to claim as a business that this incremental lift here was due to us, but we are definitely going to claim that the blended CAC drop is. This pushed LTCM to CAC into above a 1 position, which means that we're actually profitable on acquisition, which means that all of these 600 customers that we acquired here, we did it actually profitably. And so now these people are just going to come back and now generate returning customer revenue profit contribution, and we're turning the business around. And this is sustaining this month, and this will sustain moving forward in time. We will not go back to a sub 1, or if we are going to go to a sub 1, we're going to go to about a 0.95 to where we're going to repay it. So that's the context. A lot of context required, but this is a really complex individual case where we had to look at the acquisition strategy individually and then determine KPIs from that. So what did we actually do? Well, here's a few core things that I believed moved the needle. Because once again, it's the inputs that generate the outcome. And if the outcome is the $30 CAC, what is the inputs that need to change to generate that? Number one is creative velocity. And so this is how many new creatives they were introducing to the account over time. You can see quite evidently when we came in and started working with them. And so they were introducing 3, 1, 14, 10, and you can obviously see this graphed in the blue line here. The fact is that they weren't introducing much at all. In fact, they never introduced above about here, which is 17 creatives per month. And then we obviously came in and immediately caused this inflection where we went up and generated 28 new creatives in month 1 and then 35 creatives in November. Now you'll also see this green line, which indicates winners. Now this is being calculated as spend threshold of ads, using spend as a proxy for performance, and then determining if an ad has spent X amount that it is a winner. We won't see winners on any of these new ads yet because there just hasn't been enough time for them to spend, which leads into point number 2, which is spend. We realized quite quickly that spend was way too high. And we realized this through 2 pieces of analysis. Piece of analysis number 1 was doing a regression model. And so let me put this in here, was doing a regression analysis of all historical data on acquisition mirror and spend and the relationship between those 2 figures, looking at when spend went to a certain level where acquisition mirror dropped below the point of profitability, identifying that point, and then adjusting for seasonality across the year. And so we now knew what the optimal spend level was across the year for this individual brand, given their historical data and historical performance. Now, that's only one piece, and I want to put more pieces of analysis in to actually come to a conclusion here on what we should spend. So we also did a decomposition analysis. And so a decomposition analysis is looking at all historical data, decomposing it into its increments. So in this month, we spent 15,000. This was the revenue. This was the acquisition. In this month, we spent the same within this bracket. So we're going to average them together. And so you're taking all of these different thresholds of spend that have occurred historically. You're taking months where it has occurred at the same level of spend. You're averaging them to know, okay, when we spend between 10 to 15,000, what's the average return? What's the average revenue? And then you're doing this across all levels of incremental spend that has occurred within the account. And then you're doing extrapolation in between the levels of spend that you don't have, and obviously extrapolating higher if needed. And this is actually what a decomposition analysis looks like. This isn't the actual data for this particular brand. This is another brand, which shows this quite clearly. And so when this brand was down spending, let's call it $23,000 here, their acquisition mirror was up at an 8, and that's how much revenue they were generating, and that's how much profit they were generating. And then over time, you can see the trend. Now, the issue with the decomposition analysis is it isn't clean because you're using real data, and real data is always dirty and has different factors that are going to impact things. For example, like why at this spend level did profit go down and then profit went up here? Well, it might have been that in the case of these months, they incorrectly spent on the wrong kind of incremental campaigns, and then they fixed themselves once they got to higher spend and they started spending more efficiently and better. And so that doesn't necessarily mean that this level of spend is less profitable. It just means that when they spent this level of spend, it was less profitable, probably because the strategies employed at the time. But it allows you to at least get another data point to be able to triangulate the optimal level of spend that you should move forward with to be able to make the acquisition strategy profitable. And so that was the second piece of analysis that was used in addition to a regression analysis to find the optimal level of spend moving into November. We then also did an analysis across the platforms. And so we wanted to identify platforms. We wanted to identify, should we be spending on Google predominantly, or should we be spending on Meta predominantly? Now, Meta looked good in terms of the attributed ROAS was about a 15, but once you went down to 7-day click, return on ad spend dropped to under a 1, which meant that immediately it didn't look like this was a channel that was driving incremental revenue and driving the results that we actually needed. And what we then looked at was if we break down every single day into its individual units of acquisition mirror and spend distribution across Meta and Google, and we look at it across deciles, which is splitting the population into increments of 10%. So up here, this is the top 10% of days. This is the bottom 10% of days. In the bottom 10% of days, you can see that Meta spend trends higher. Google spend trends lower. Now, immediately, this should tell us that, okay, well, when days are terrible in terms of efficiency, they tend to be days where we pull out of Google and we put into Meta. not very convincing for spending more on Meta. And then vice versa, at the top level, it gets a little bit ambiguous. So on the very best acquisition mode days, we actually see a slight spike on Meta. And this is probably skewed by promotional material going up during specific sales periods. But then this ends up trending itself down right after this and then remains flat and then obviously does another trend up. And so this still told us conclusively that Meta doesn't seem to be the better performing platform. And so we're going to skew spend out of Meta into Google. We took about 30% of the budget out of Meta and moved that to Google accordingly. But we still need to make Meta work. Just because historically it hasn't worked, this is ultimately going to be the more scalable platform for this particular business. They were bridging up close to maximum search volume on Google. And so Google wasn't going to provide any kind of incrementality over the long term. Yes, this would provide immediate efficiency within the account. In fact, we could just distribute all spend into Google. We probably would have seen the best incremental return, but it isn't a long-term fix for Meta. And so we need to keep spend in the platform to be able to continue to test and optimize and then move forward here. And then the last important point worth mentioning here is, I'm just going to call it iROAS. And it's going to encapsulate so many different changes that lie within us. And I'm not going to give you these specific changes as it's going to be too specific to the account and not be directly relevant. And so I think zooming out just to the concept in itself is an important takeaway, which is really this is spend distribution, but not at the platform level, but at the campaign level. And this was identifying what campaigns are actually driving incremental returns. If we go and put an extra, and this is always the simple example that I go to, if we go and put an extra $10,000 into brand search, are we going to see a 5x return? No, we're not, because we're just spending more for the existing people that were already searching for us, that we already had 100% impression share on. There's a zero return on that dollar allocation. And so we want to identify the campaigns that we believe are overspending. Do we think that this campaign that's spending $5,000 a month, do we think it could be spending $4,000 and generating about the same amount of revenue? Is that top $1,000 really generating incremental profit? And the answer often, if you look through an account and you look through all the campaigns, the answer often is no for quite a few of those campaigns. And so you can immediately identify 2-3 campaign opportunities where you can take out $2,000 from here, you can take out $1,000 from here, you might be able to take $500 out of the brand search, for example, because it's on an inefficient bidding strategy. And then you can go and redirect this. In this case, we needed to take spend out regardless, but we did redirect some of this budget into campaigns that we believe are incremental. In this case, it was specific shopping and a specific cold campaign type on Meta. And so we took it out. We saw almost no attributed revenue drop or no back-end revenue drop. And then we moved it in to campaigns that we believe are driving incrementality. And it's through the layer up of all of these different changes across the acquisition strategy that ultimately the change in inputs generated a change in output, which was blended CAC got pulled down by $7 because we cut out a lot of wasted spend. We refined down to what we believed was the optimal spend level to acquire customers. We proved that that wasn't too low of a spend because new customer acquisition didn't drop substantially. Yes, it was lower than April through to June, but they were spending 3x the amount in those months. And they were doing it at a level that was never repaying CAC. This was just burning money forever, and they were never going to see a return. And so we turned it around, we became profitable. And once again, that was primarily through increasing creative volume in the account, increased efficiency, increased our ability to distribute spend across more ads that had lower spend thresholds. And to just give you a bit of a better understanding about what I'm actually saying there and why this is an important one, is that there is a fundamental truth that is associated with each ad that exists within the account, which is that an ad has a maximum daily spend capacity. And so when you put an ad into an account while maintaining efficiency, and so you could put an ad into an account and it might be such a terrible ad that you can spend nothing on it profitably. Okay. But you might also put an ad in the account and it spends profitably. It's a good ad. And then you go and scale it and you take it to $50 a day, $100 a day, $200 a day. And then at about $200 a day, the efficiency drops off and it can't actually profitably maintain an ROI at that spend level. And so you go pull it down to $150 and you can keep it sitting there. And that's fine. You have an individual ad unit that is within the account that is spending $150 a day. But if we want to spend $300 a day, well, we need another one of these. And maybe we launch another ad and it's profitable and we start scaling it, but this ad can only spend $50 a day because it's just not good enough at going to colder and colder audiences and acquiring them profitably. It only works in a very specific, constrained targeting, which can only be done at $50 a day currently. And then we layer another ad in, and this is maybe $300 a day. We get onto a really big winner. And then we layer another one in, and this is not really proven yet as $20 a day. And so it's through layering all of these creatives together, which all have maximum daily spend limits in which they can maintain efficiency, that we can actually then stack up and layer to our total budget here. And so when we're talking about increasing creative velocity, we're doing this so that we can increase the capacity to have ads that, if they are working and if they are profitable, that we can horizontally stack up the maximum spend capacity of them all so that we can actually maintain efficiency within the account at these spend levels or increase spend even further. And so that's the reason why this ended up becoming such an important part and component of the strategy. We then dialed spend in. We did 2 different pieces of analysis so that we could start to triangulate where we believe the optimal level of spend was for this particular brand. We redistributed budgets across platforms based on a decile analysis, as well as just looking deeper into the data, looking at 7-day click attribution and starting to pull away some key takeaways about which platform was actually driving acquisition. And then we looked at incremental return on ad spend at an individual campaign level across the platforms. And so what campaigns do we think were just overspending without incremental results within them? That's a big data piece, looking at historical data as well as knowledge across our portfolio. We took that spend out. We've redirected into spends that we believe were incremental. And so if you currently are unprofitable on acquisition, this is a recommended approach that I would take. These are some core things that I would look at. And obviously, if you would like us to have a look, do a growth evaluation, put together an analysis very similar to this and provide you with a roadmap, click the Blue Sense Digital link in the description below and reach out to us for a free consultation.